I'm about to give you a list of 5 quality stocks that you can buy right now as we start the new year. These are all companies that I believe will outperform the broader market in the long run. Last year, I picked Alphabet, Amazon, and Uber as my top 3 stocks to buy, and they performed very well, especially Alphabet rising 65% and Uber rising 29% compared to the market at 18%. Amazon didn't fare too well, underperforming the market by gaining only 6%. If you weighted the 3 stocks equally in a portfolio, it would have returned 33% in 2025. Ironically, I would have been better off going all in on these 3 stocks myself. I owned all 3 in my portfolio, but invested no more than 10% of my capital in each. Speaking of Amazon, that's the first stock on our list to buy in 2026. Yes, it underperformed the market in 2025, but that just makes me more bullish on the potential for Amazon stock to rise at a higher rate. Amazon's business model consists of diverse revenue segments, including the well-known e-commerce business, but also faster growing, higher margin segments like AWS and advertising. Amazon has been spending huge amounts on capital expenditures, around $120 billion in the last 12 months. CapEx is basically money spent on investments to upgrade the operations of the business. Most of this money is being spent to maintain competitiveness in cloud computing via their Amazon Web Services business. Like I mentioned before, this is a highly profitable business for Amazon with operating margins at 35%, much higher than the average 10% that the overall business produces. Therefore, as Amazon fuels AWS's growth with accelerated CapEx spending, the overall margins of the business should continue to climb. At some point, I believe the market will recognize this by re-rating the stock higher, probably once Amazon slows down its CapEx, which would send the free cash flow significantly higher than analysts are expecting. The Amazon story is one of long-term margin expansion through scale, which has often been underestimated by Wall Street. The next stock to buy in 2026 is Mastercard. Mastercard acts as a digital railroad connecting a consumer's bank to the merchant's bank whenever they make a transaction. Mastercard makes a small fee on every single transaction that occurs on its network. And this network facilitated $2.7 trillion worth of transaction volume in Q3 2025 alone, making it one of the most profitable toll booths in the world. The current valuation of Mastercard stock is close to the cheapest it's been in the past 10 years from a free cash flow perspective, as you can see from this chart of their free cash flow yield. The higher the free cash flow yield, the cheaper the stock. You'd think the valuation is getting cheaper for some fundamental reason. However, looking at Mastercard's numbers, you'll find growing operating margins, re-accelerating free cash flow growth, and huge share buybacks, creating even more shareholder value. If I had to rank these 5 picks, Mastercard would probably be my number 1. You've got arguably the strongest company in the world selling at 30 times its projected 2026 earnings. Next up, we have Meta Platforms. Similarly to Amazon, Meta has been spending like crazy, investing $63 billion in the last 12 months, mainly on computing power to fuel its social media ecosystem, which currently has over 3.5 billion daily active users. The market is currently valuing Meta stock at 22 times its projected earnings in 2026, which I believe is very conservative. Market analysts are concerned that Meta is spending all this money on capex that could be returned to shareholders on unprofitable AI-related ventures. However, I see it differently. As a user of their apps, mainly Instagram, I've noticed the algorithms increasing personalization, which should increase overall time spent on Meta's platforms, therefore allowing Meta to show users more ads, and with the integration of more powerful AI, those ads will be better targeted and more profitable for the company. Again, like Amazon, Meta's free cash flow has been suppressed by their spending on AI infrastructure. Therefore, if they decide to take their foot off the gas slightly when it comes to investments, their free cash flow should skyrocket. I see Meta as one of the most undervalued big tech companies in the market right now. The fourth stock to buy in 2026 is Netflix. You may have heard the news that Netflix made a deal to acquire Warner Bros. Streaming and studio assets. Whether the deal goes through, regulators prevent it, or Warner Bros. Decide to take the offer from Paramount, Netflix will be just fine. And the current dip in the stock may be looked back upon as one of the greatest buying opportunities in the market. The stock currently trades at 29 times 2026's earnings, which is incredibly cheap for a company growing free cash flow per share at close to 30% per year. I believe the growth in free cash flow per share will moderate slightly over time to around 15%. However, that is still exceptional for a publicly traded US stock. The company still has massive leverage to grow its free cash flow faster than the market expects because their subscription prices are still relatively low compared to their competition, despite offering greater value. Raising prices often has an outsized impact on profits because it costs nothing to do. Therefore, all that extra revenue will fall straight to Netflix's bottom line. Over the long term, I expect Netflix stock to significantly outperform the wider market. The final company of the 5 quality stocks to buy in 2026 is Uber. Uber stock faces skepticism from investors mainly due to the emergence of autonomous vehicle technology. However, I believe that this trend will be a tailwind for the company long term rather than a headwind. Think about it, the company's largest expense is driver incentives. If you get rid of the drivers using autonomous vehicle technology, you instantly spike profit margins. We also have to accept that this shift in technology will take time, maybe over 25 years, to go from human drivers to purely autonomous vehicles. And even then, regulators may block AVs in certain locations. This gives Uber time to adapt to new market dynamics, but I think the current management team have things pretty well planned out. With the current free cash flow yield sitting at around 5%, I think there could be significant upside in Uber stock, especially if free cash flow per share continues to grow between 15 and 20%. If AVs really do turn out to be a tailwind for Uber, I expect the stock to outperform the wider stock market in the long term. That's it for today's video. I hope you enjoyed. See you in the next one.